Okay, this is Rhonda Thomas, and we're just about to do Managerial Accounting Chapter 12's intro information and exercises. So I've shared my screen, I believe. All right, so this is capital investment analysis. Okay, what are capital investments? Sometimes it's also called capital budgeting. Okay, capital budgeting. It's coming up with the funding for something you're wanting to do in management to grow your business, okay? I guarantee you that most of the ones that go on Shark Tank are now at the point where they need to raise capital. That's why they're there. And so they've probably already gone through some of this in order to make decisions about what they're going to do. Here's what you need to know. We're going to do 4 methods. Okay, there are 2 methods that do not use something called present value. Okay, so have any of you ever heard of time value of money in any of your classes? There's present value, future value. We're going to work with present value, and you're going to have tables to use, but the first 2 do not include present value. Okay, so we're going to work on those 2 first. And then we'll add the ones that do take into account what's called time value of money. And I teach a personal finance class. I know you guys are already on your way to something else, but it's a pretty decent class. I wish I would have known the things, and we do a lot of time value of money in that class. So time value of money concept. The idea is that $1 today is worth more than $1 tomorrow. Okay, because of inflation, right? Because of inflation, what you can buy today with your dollar, you're not going to be able to buy as much later. Okay, but you can also put that money in an account that pays interest, and you can end up with more money in the future by putting your money. So it all has to do with money, time, and interest. Okay, all has to do with money, time, and interest. Okay, so the first one we're going to work on, the first 2 do not involve time value of money, so they're going to be simpler. And they're going to be simpler. Here is the average rate of return method. Okay, sometimes it's also called the accounting rate of return. And accounting loves to give something a title and then give it several other titles. And you're going, how am I supposed to remember all of that? But that's just accounting for you. Okay, let me open up my 12 here. Yeah, good. Glad to see it's in here, because I was working on this. All right. Okay, so let's go to the problem. Here is the formula. Here's the formula. Okay. Once again, time value of money. Just so that you know, there are 2 future values and 2 present values. No, I'm not testing you over future values. That's not what we're using in this chapter. But we will be using both of these present values. Okay. So the thing you need to pay attention to is PV stands for present value. Present value is today, today's money. Now we have 2 of these. And when we have 2 of these, that means we have 2 tables to go look at. So we use tables here in accounting class. There's actually some time value of money calculators that you can go out online and use, which actually are pretty cool. That's what we use in personal finance. So if it says present value of $1, that's one amount. Okay, one amount. If it says present value of an annuity is more than one amount, but it has to be the same amount. An annuity is payments of the same amount every period. It might be every month, it might be every year, but it has to be more than one amount. Okay, so when you see that word annuity, okay, that's going to mean more than one amount. and once again, the capital investment evaluation methods is the average rate of return, the cash payback, and then when it comes to present value, using the time value of money, we're going to do one called net present value. And then we're also going to do one called the rate of return. I'll put that in there when we get there. All right, let's take a look. So usually these aren't too bad. So here's the idea. A lot of businesses have what's called a required rate of return. Okay, a required rate of return. That doesn't happen to be in this one, but oh yeah, there's the other one. Internal rate of return. I got too many spaces going on here. That one goes up there with that one. So this one is the average rate of return. So if you wonder how to get to these numbers, if you need to get to average investment, which is this denominator here, here's how you would do so, right? So this is actually this piece. And then you have average annual income. All right, so let's see what we've got here. I think they've already broken it down for us a little bit here. Okay, so let's see. So determine the average rate of return for a project that's estimated to yield. Yield means a return. Total income of $395,250 over 5 years. Okay, total income over 5 years. Has a cost of $948,600 and has $105,400 residual value. Okay, so we're going to try to set this up, what we can see. So the average annual income, okay, so we could take this number and divide by 5. Okay, so here is total income for 5 years. Total income for 5 years. Okay, so let's put that in. Okay, and then we need the average annual income. So if you divide by 5, I believe you would get your average, right? Okay, so let's divide this by 5. And we'll put that beside it to get the average annual income. So let's put divide by 5 years. Okay. All right, so I got $79,050 is my average annual income. Okay, so average annual income. Now let's try to find the average investment. And they did give us the pieces that we need, right? We need the initial cost and the residual value. Residual value is what you will get back if you sold it at the end of whatever capital venture you're doing. Okay, so it must have salvage value. This is also known as salvage value. All right, so we're going to take the cost plus the residual value and divide by 2. Okay, so initial cost is $948,600. Okay, our residual value is $105,400. Now notice we add these two together. When we were doing depreciation, we actually subtracted the residual value. So please keep in mind that this is plus, and then we'll be dividing by 2. So we're going to add these two together here, and then we'll divide by 2, and then we'll have our numerator and our denominator. Okay, so there is the denominator here, right? This is the denominator, and this is the average investment. So now we've got the numerator and the denominator here. So let's see what we get. for our percentage. And the average rate of return will always be a percentage. All right, so we have, here's our average annual income divided by average investment. Okay, I just want to make sure that I have done this. Okay, so if you want to turn that into a percentage, and they want it to the nearest whole number. Well, I like to also see what it is. Okay, the nearest whole number. So it looks like mine is 8%. Did anybody get anything more than that? Have you tried it? Okay.
I got
What'd you get?
20%.
Oh, it doesn't like it. Hold on. Let's see what's happening here. Okay. 948. 600 is the initial cost, residual value. There's the average investment. Okay. And so let me see, divide the estimated average annual income by the average investment. Yes. So yield total income. Now here's what's kind of difficult to understand sometimes. If you see this, this may not be the total income for 5 years. It's just the average income for each year. I don't know. I'm going to guess that's the case. And that's the problem with some of these. They don't tell you enough information. Okay, so I'm going to go ahead and see what happens if I use that instead. Okay. So the average rate of return, that seems awfully high. Oh, I don't think that's it either. I'll go look at my key and see what's going on. So I'm going to put 7.5, even though they said, nope. Okay. All right. Let me try 38%. That seems awfully high. Okay. So let me see what's happening here. Okay, no, all right, so 395, 250 divided by 5. That's what it's showing, right? Okay. The average rate of return. Okay. And I got 8%, but I'll do it again. Oh, here's what I forgot to do. I forgot to divide by 2 right here. Okay. So I will put dividing by 2. So there's one more piece to that denominator that I didn't complete. All right. So we would take this and divide by 2. Right. And then we'll get the average investment. Okay. And now let's do our, so if this is our numerator and this is our denominator and this is our average investment, should be okay now. All right, average investment. Okay, so I got to go back to the 5. So that was correct. I figured as much, but sometimes okay, so there we are. And then the annual income divided by that investment is going to give, I got 15%. Okay. 15%. And that makes sense because I didn't divide by 2 a little bit ago and it was 7.5. So now let me put this in here and give it a try. So here's the idea. If you're going to do this project, okay, if we're going to do this project, this gives us an idea of how much we'll make on it. There we go. You've got to put, it says round to the nearest whole number, but then it wants me to put in a decimal. Okay, does anybody need help?
No.
Did you get it?
Yeah.
Okay, so one more time. This is the total income over the 5 years. Okay, but it could have also been interpreted as that is the income of each of those years. But anyway, so You take that whole number divided by the number of years to get that annual, average annual. Then you take the initial cost of the project plus the residual value and divide by 2. Okay, so then once again, this is the numerator and the denominator, and this is called your average rate of return. Okay, average rate of return. And just for the heck of it, it says, here's what this says. This is a method of evaluating capital investment proposals that focuses on the expected profitability of the investment. Yeah, so when you're going to come up with the funding to do something in business that probably is pretty substantial, there needs to be some kind of idea of the return that we can expect from it. Okay, so this is an analysis that we're doing here for these different methods to provide justification to either do the project or not do the project. Okay. Here's the thing. Let's say that a business has a certain threshold of a return. So let's say a business won't do a project unless it surpasses 5%. Okay, let's just say. So this is another way to decide whether you would do a project or not. Okay, we do okay. This one's not too bad. Just have to remember to divide by 2 for that average investment there. Okay. Does anybody need any help, including those of you out on Zoom? If you need me to help you with something, please say so. We will work it out. Okay, this next one is called the cash payback period. Okay, cash payback period. Here's what the book says. It's an expected period of time that will elapse between the date of the capital expenditure and the complete recovery in cash or equivalency of the amount invested. So this one is, I think, pretty easy to understand from an individual's point of view. If you buy something that's supposed to help you save money later, right? You've got to pay for that and get past how much that costs you before you actually start saving money. That makes sense? So a payback period is how long does it take us to recuperate what we spent, so then we actually start making money on our project. Okay, so a project has an estimated net cash flow of $36,500. All right, so here is the formula for the cash payback period. We take the initial cost and we divide by the annual net cash flow. So we're going to invest this money to hopefully have this cash flow come in. Okay, so let's put it together. All right, shouldn't be too bad if I'm reading things right. Okay, so we've got the initial cost of $102,200. That's going to be the numerator. Of $102,200. And then the estimated annual cash flows. Okay, once again, this is a guess. All right, so and it's net. Something's been subtracted. Okay, something's been subtracted, but they gave us the number. So we didn't have to do the math on that one. All right, and this one is 36,500. So I've got this set up as the numerator and the denominator, and this is the number of years. So this is a payback period. How many years is it going to take for us to recuperate the cost, and then we'll be making a return on our investment after that? Okay, so let's do the math here. Okay, initial cost divided by the inflow of cash that it's supposed to bring in. So I got 2.8 years, okay, 2.8 years. They want round your answer to 1 decimal place. So once again, this project that cost us 102,200 with an estimated annual net cash flow of 36,500 should pay us back in 2.8 years. Okay, 2.8 is what I got. So let's key this in. And once again, we don't concern ourselves with the time value of money for either one of these. Okay, time value of money. So there's that one. Okay, so once again, payback period is usually a number of years. I guess it could be a number of months. Sure, maybe if something had a monthly cash flow, it could be, paid off within, depends on what they're talking about. All right, so I'm going to go ahead and make this green. And then our answer up here was here. Okay. Okay, now we're going to cross over into using the other two methods that do include net present value. Okay, net present value. So if you'll give me just a second here, I'd like to show you a problem and how it's worked. Okay, how it's worked so that we know how this goes. Okay, so I'm going to go out to my book. Okay, so let's move over here and see if we can walk through, because sometimes this gets a little confusing. It can. So present value concepts. Present value concepts. Remember, there's the present value of $1. So you see this one, it says present value of an amount. That's one amount. Okay, I usually use the $sign to mean one amount. Okay, and then this one is present value of an annuity. Okay, so this is one amount, and this is more than one amount. Okay, so here's the idea. Okay, here's the idea for present value. When it comes to time value of money, we're going to be looking at interest, oftentimes compounded interest. Compounded interest is interest on top of interest on top of interest. And that's how money grows. And there's a point in time that if you have enough money and enough compounded interest, that pretty soon, woo, your money grows quite a bit. But that's future value, sorry. All right, so we're going to have to learn to use these tables. Okay, we're going to learn to use the tables. So let's pay attention to what's across the table, right? This is just a partial one. By the way, this is the present value of one amount. So if you had just one amount, you would use this table. If you have an annuity, you would need to use the other present value table. You say, how do I know which table I'm on? Well, it should list it, right? So if it says present value of 1, then that's the one amount. The other way you'll know is all the numbers on the table, okay? All the numbers on the table are less than what? Less than 1. Does everybody see that? Less than 1. Okay, so what you have to do is you have to find an interest rate of some kind, and then the years that are involved. So time value of money involves compounded interest and time. Okay, so here's the idea. So if you had a present value, okay, if you had $1 that represented $1 today, how much, okay, this is also called discounting. How much would that present value be discounted with? So what we need to do is the amount to be received in 3 years. Okay, in 3 years. So we're gonna use an amount, $1,404, and we're gonna go find the present value factor, and they've got it highlighted here. So this would be 12% in 3 years. So we would use this factor. So here's our amount that we want to see, the amount to be received in 3 years, $1,404 times 0.712, and that came from lining up the horizontal percentages and the vertical years. Okay, so here's the idea: the present value, if you want $1.40.4, okay, if you want that in present value, okay, so the present, so 3 years, the present value of today, all right? And if you take this number times that factor, of course, you get a lot lower number, right? And by the way, this is $1.40. I'm sorry, I thought that was 1,404. Sorry about that. Now let's look at an annuity. Okay, the thing about an annuity is it has to be more than one amount, and it has to be the same amount year after year. So here's an example of an annuity. So if you are receiving $100 for the next 5 years, you could then use the present value of annuity table. Okay, we only had $1 value in this one when we've talked about the present value of $1 or present value of an amount, just one amount. Okay, but when we look at the present value of an annuity, we would also use a same kind of a table, but look at this table. All of the numbers are more than 1 except for year 1. Okay, so notice these are bigger numbers than this table because it's pretty easy to get confused as to what table to use. Okay, so I'm trying to kind of guide you with that just a little bit. Okay, so the present value factor for $1. So the present value for $1 for 1 year. And these are the factors that are coming from table 1. Turns out you could actually use table 1, but you'd have to multiply it out 5 years into the future. And if you add up all of those, that is the number that you find if you looked up 5 years. All right, so this number here, right, 3.605 goes along with being 5 amounts of the same one. This one is just one amount at 12% for 3 years. Okay. All right, let's see if we can understand this present value method here. So we're going to take the cost of equipment, its expected useful life. You're also going to receive some kind of minimal desired rate of return. This is the rate of return that the business has decided that that's the minimum that they will accept in order to do a project. Okay. So then the expected cash flow to be received each year. Notice each one of these are different except these 2 years. So this is the total expected cash flow. All right. So we're looking at 5 years. So if we were to use a table, okay, we would take year 1 times the factor of year 1 at 10%. So you would put all these are called present value factors. You'd put the factors in and then you do the math. So $70,000 cash flow for the first year. The present value of that is basically 90.9% of it. And as the further you go out into the future, right, the 5th year, that net cash flow for year 5 in today's money is only worth $24,840. So you have to take that net cash flow, and notice these percentages go down, okay? So in year 5, the cash flow that we're going to get for year 5 is only worth 62%, 62.1% because it's in the future. So you add up all the present value net cash flows and you do what? You subtract the amount to be invested. So this is the net part. The net part is subtracting the amount you invested, and then you'll get net present value. Okay, net present value. So we take the total present value and subtract the amount invested. There's the extra. There's the extra that's coming about. All right, so let me go back to my problem now. Oh, hang on. I just got rid of it. Okay. So we're going to have to do some calculations here. We're going to use the table. And we might need to use both tables. Just depends on what they're going to have us do. So we're on number 3 now. All right. So let's go ahead and label what we have. Okay, it says we have an estimated annual cash flow of $15,000 for 10 years. And it's estimated to cost $45,000. So let's take 15,000. That is our annual net cash flow. Okay, so annual net cash flow. Okay. So now we need to figure out, and because this is going to be 10 years, right? That's more than one payment, right? Yes. So 10 years worth. 10 years equals 10 amounts, basically. Okay, so we're definitely going to use the present value of an annuity. Okay, so we're going to use the table, present value of annuity. Now let's see, here is the estimated cost. Okay, the estimated cost, and then they have a minimal accepted rate of return. Okay, so the estimated rate, the estimated cost, okay, is 45,000. And then we have a minimal rate of return of 20%. And I'm going to put this in as a percentage here because, okay. So now we're going to do the math here. Okay, we're going to do the math. So we'll set us up. There we go, 20%. Okay. So the first thing we do is take the cash flow. And then we're going to use this because their minimal rate of return is 20%. And we're looking at 10 years. So we're going to use this factor right here, or at least for mine, 4.192. And I like to put beside the present value of annuity factor. Okay. I like to put beside it the variables that I use to look it up. So we're looking up 10 years, 20%. Okay, so it's good to label what you've got. Okay, so the factor is 4.192. Okay, we're going to take the annual cash flows times 4.192. Okay, that is going to be your net value. Oh, we got, and then we got to subtract the cost. Okay, so let's do the cash flow part first. Okay, and all right, so net cash flow. So this is 10 years into the future. So we're going to take the number of the annual cash flow, and then we're going to take it times the factor that we found from the table. Okay, and we got a dollar value. And then we have to subtract, the estimated cost. Okay, so less the estimated cost. Okay, so I'm gonna put this in here, and then I'll put this in to show how this gets calculated. So it's net cash flow. This is of an annuity, right? Because it was 15,000 10 times. So that makes the table that we needed be the one for annuity, even though that's the only one they gave us. And now we can subtract this, and we should have the net present value of the project. Okay, net present value of the project. Okay, so there's that. Let's see what we got here. Net present value of project. Actually, I'm going to call this project net present value. Okay, so they want it to the nearest dollar. Okay, mine came out in whole dollars. So let's see, 17,880 is where we're at. Okay, the present value index rounded to 2 decimal places. Present value index. Okay, so okay, divide the total present value of, here's how you get the present value index. Take the total present value of the net cash flow. So that's what we just found. The total present value is right here. Okay, and let's just make sure I'm on the right track. Should be. Okay, so we should take it says divide the total present value of the net cash flow by the amount to be invested. So here we're subtracting it, and now we just simply want to divide. So we're going to take here and divide by the cost. Okay. Okay, and let's see here. So round to 2 decimal places. So let's bring that down to 2. Okay, I got 1.4. Let's see if I'm right. I think you can ignore. Yes, you can ignore the negative. What if you put that in? I just wanted to see if they take it. The reason is because I have this in as a negative amount because that's the cost. So don't put that in as a negative because then it won't be correct. Okay. All right. So there's how you did it. And beside that number, I'm going to take, all right. So I'm going to show you this again one more time. So you take the net cash flow total that you figured, and then you're going to divide by the cost. Okay, divide by the cost so that you get a positive number. Okay, and then this is, so I'm going to put this in here. This is net cash flow divided by the estimated cost. Okay, that's how I got that number. Okay, and right, if required, use the minus sign to indicate a negative net present value. So that's why you can't do that. Okay, just so you know, the present value index is computed by dividing the total present value of the net cash flow. Yes. Okay. To be received by the amount to be invested. Present value index. All right. Okay, so there's part of our answer and the first part. Okay, let's keep going. Now we're going to learn the internal rate of return. Okay, internal rate of return. It's also going to use time value of money. Okay, so we're going to use a table. And I want to put the calculation here. Sometimes this internal rate of return is also called the accounting rate of return. It is a proposed capital investment uses present value concepts to compute the rate of return from the net cash flows expected from the investment. So a project is estimated to cost $97,237. Provide annual net cash flows of $29,000 for 5 years. Okay, so here comes our net cash flows. Okay, so this is the amount that is supposed to come in because of the project for 5 years. And it usually has a life. Okay, it usually has a life. All right. All right, and then it has a cost. So determine the internal rate of return for this project using the present value of an annuity. The reason we're going to use a present value of annuity is we're going to receive this cash flow more than once. Okay, so I will put present value of annuity. That's how you know, and that is the table that they give you. But sometimes you have 2 tables to choose from, and you have to know which one to use. Determine with the present of a dollar at compound interest table shown above. Okay. So we need to understand. All right. So this is where we're at. Let's go back to our problem in the book. And I want to show it to you from that point of view. Okay, so internal rate of return. Okay, so what we do is we take the net cash flow and we find the present value factor of an annuity based on a minimum rate of return for 5 years. So just like we did this one, okay, and then we subtract. Nope. Huh? Okay. Okay, so once again, that's the net present value analysis at 12%. That's this one. Okay, so now we want the present value of an annuity at the internal rate of return. Okay, so when equal annual net cash flows are expected from a proposal, as in the preceding. Okay, so the present value factor of an annuity equals the amount to be invested divided by the equal annual net cash flows. Okay, and then you go find, so you have to look at the table to find the present value factor. So when you're doing the internal rate of return, you're going to go find the percentage. Okay, up here, we went and found the percentage based on 10 years at 20%. Now we're going to have to find the percentage by what they tell us. Okay, so one more time, we're going to take the amount to be invested, right? And then we're going to divide by equal annual net cash flows. I'm going to copy this and put this right here with this, so you know what the formula is. Okay. This time we're going to be looking for the percentage, the present value factor. That's what we're actually going to be looking for on the table. Okay, so there is that. Let me put the cost down for my problem. Okay, my cost is $97,237. Okay, so that is the estimated cost. And that's going to be the numerator. Okay, so we're going to take this number and divide by the net cash flows. Okay. Okay, we got 3.353. Now we're gonna look here. So let's see if we can find the closest number to that. And sometimes, all right, so it says determine the internal rate of return for the project using the present value of an annuity table shown above. Okay, so we got the present value factor. So once again, you have to find a factor that's as close to that as possible, right? So there it is. It's perfect. It's perfect. All right. There it is. That's the factor. And that means that our internal rate of return is what? 15%. So it's whatever column that number is. So go find number on the table and use the percent, the percent above, okay? So that's going to be the interest percentage. Okay, so that's how you do this. Okay, and like I said, that is the number. Sometimes you can just have to estimate between two. All right, so 15% is where we found it to be. Okay, so the internal rate of return of this project is 15%. Okay, 15%. And if they have a minimum, they didn't tell us what our minimum is, but if we have a minimum, if 15 meets it or beats it, that's whether they decide to do the project or not. Okay, so once again, this is called the internal rate of return. Okay. Let's check it, make sure I'm right. Very good. Last one. Okay, now, occasionally you will have projects that have different lives. So one might last, like this one is showing, one that does 7 years and the other is 5. Okay, so you can't use the same present value when you have different time periods. Okay, so all right, this is called net present value with unequal lives. Unequal lives. So we're going to have a project 1 and a project 2. Okay, and then we have some information to fill in for each. So we'll use the net present value and then we'll just figure each one. Now notice, this one is the table of the present value of $1. This one is the present value of an annuity. All right. So when we can use it, we'll use it. When we can't, we'll just have to go with it. All right. So this one has an investment. Okay, let's put the investment down for each of the projects. Requires an original investment of $33,000. So, okay, mine is 33,000. Okay. Okay, the other one, project 2. All right, and project 2. Project will yield cash flows of $9,000 per year for 7 years. Project 2 has a computed net present value of $7,600 over a 5-year life. Project 1 could be sold at the end of 5 years for a price of $37,000. So it has a residual value, project 1. Okay, and project 1's life is 7 years. Okay. And the residual value of 37,000. Okay, project one could be sold at the end of 5 years. Okay, this is residual value. We have a 7-year life, but we're showing, nope. Yeah. So this residual value is after 5 years. Okay, for this one. So 37,000. Okay, so that's what we have. Now, project two has a computed net present value. So they've already calculated it, the net present value. So net present value is 7,600 for the project. So we're going to probably compare the two when it's said and done. So net present value. And it's a 5-year life. Okay, this is a 5-year life. Okay. So they've already figured this one. So we just need to do the math for the top one and see how it compares to project two. Okay. All right, so let's go ahead and calculate this. All right, so the net present value would be the cash flow, right? Let's see here. Oh, cash flow is 9,000 per year for 7 years. So here is the cash flow, 9,000. And this is supposed to be for 7 years. Okay. So let's see what they want done here. Determine the net present value of project one over a 5-year life with residual value, assuming a minimum rate of return of 20%. Okay. Okay, so their rate of return, minimal rate of return is 20%. And we're going to use a 5-year life. Okay, so we've got to go find a factor for present value. And the fact that we're using this $9,000 annual cash flow, but we're doing it over 5 years. Okay, so, and their rate of return is 20%. I'm going to use this table for an annuity because this is $9,000 times 5. So that is, we're going to use the present value of an annuity. And we'll get the factor here. So present value of annuity. And we're going to use 20%, 5 years, 20%. Okay, so 5 years at 20% is 2.991. Okay, so this is from the table, 2.991. And I would carry it all the way to the third digit there. However many they give you, use it. So you'll probably need to. Okay, so now we're going to take this cash flow times this present value factor of an annuity. Okay, once again, this is the present value factor. Comes from the table. Okay, so let's do that. And then we have to subtract, and we also have residual value, right? We also have residual value. Okay, so we have to take into consideration the residual value because they're looking to get some money back at the end of the 5 years. Okay, so you do have to add that together. Okay, or yeah. All right, so present value. Okay. So the present value of 22,000. Okay, so we're looking at the present value of 9,000. That's the cash flow. At 20% for 5 years. We've already found the factor. Okay, so let's take that times it. Okay, so 26,919 is, so what this is saying is 9,000, right? 9,000. If you don't use the time value of money, if you're going to receive 9,000 5 times, right? Without time value of money, it's 45,000. But the fact that you're going to receive that cash flow 5 years into the future, that money actually is this is the present value of that amount. Okay, present value of that amount. And then we're going to need to subtract the cost of project 1. Okay, so the cost. And once again, this is the present value of that cash flow. Okay, so cash flow over 5 years. Okay, so now we're going to subtract the cost, which is the required investment. Okay. So there is that. And then we're going to subtract it so that we get a net here. So the cost. So this one, we're going to get a negative, right? We're going to get a negative. So if this is the present value of the cash flow over the 5 years, and then this is the cost of the investment, when we subtract that, I believe we have a negative cash flow of 6,081. Okay, 6,081. Determine the net present value of project 1 over a 5-year life with residual value, assuming a minimum rate of return. Okay. Wanted to look and see. Okay. How this. I want to make sure I've got it. Okay. 5 years. Present value of at the end of 5 years. Total present value of project 1. Okay. So before we get to the cost, okay, we have to do the cash flow. And we got one more piece in here that we need to get. Okay, one more piece in here. All right, so if this is the cash flow for those 5 years, then we need to do the present value of, okay, so we have to do two present value amounts. Okay, that's why they gave us 2 tables. This other one is the present value of so what you have to do is, here's the cash flow. Now that we have residual value, we have to take the present value of that residual value. Okay, the residual value is the 37,000, right? We need today's money because we're going to sell that in 5 years. So we need to use this table here at 20% in 5 years. So here's the factor to use, okay? And then we subtract the cost. All right, so we've got to know, because we're getting that residual as proceeds coming back to us because of the project. Okay, so this is the present value of the residual value, which is the sales price in 5 years. Okay, so I'm going to show how I'm going to calculate that here. All right, so you use this table because it's one amount of 37,000. I'm going to show you the present value factor that we're going to find. So present value factor, present value of $1. So because it's just one amount. Okay, and we're going to use, like I said, we're going to use 20% and 5. So 20% and 5. So we're going to use 0.402. I'm going to put that here, 0.402, and leave that as a number and use all of the decimals that are there. Okay. And once again, that is 20% for 5 years. 20%, 5 years for 20%. Okay, that's where I got that factor. So now I'm going to take 37,000 times 0.402, and that's going to give us the present value of that sales price. Okay, so it's about 40%, right? It's about 40%. So what you do now, okay, now that you know that you're going to add those two together. Okay, you add the present value of the cash flow and the present value of the one amount of the sales price. Okay, so we're going to add down and then subtract the cost. Okay, we're going to add down and then we're going to subtract the cost. Okay, so there you have it. There you have it. So here we go. Just one more time for the record. This one had cash flow for 5 years, and the cash flow was 9,000. So the present value of a cash flow for 5 years, we use the present value table that says annuity on it. And there's the factor that we use to find this number. Then to find the present value of just the one amount of the sales price, then you use the other table that doesn't have the word annuity. So we're looking at 20 at 5.402. There's the factor that I found. I take that times the residual value or the sales price, and that goes right here. These two get added together, and then you subtract the cost of the investment. So this one has the net present value. Okay, so sometimes it's just NPV, net present value. This one has a higher net present value than project 2. Okay, so putting it in, okay, I got 87.93, and they just want it to the nearest dollar. Okay. Okay, so which one gives you the most money? Mine is project 1. Did anybody get project 2?
I did.
You did. Okay. Okay. So I didn't know if they were doing both in different directions, but whichever one comes out higher, that's the project that you will probably go with. Yep, probably go with. Okay, that ends us with our intro exercises. Okay, so one more time, 4 different methods to evaluate capital projects, basically. figure out whether you should do it, to figure out if you need to choose between things, right? So that's all I got. Okay, guys, on Zoom, stay put. I'm gonna stop the recording here. Thank you very much. We'll do the other problems for chapter 12 on Thursday.
That's good.
Okay, so we're almost in the clear. Very good. Thank you, Zoomers, for joining us. I'm just gonna stop my recording a minute so I can do attendance.
See you, Rhonda.
See